I'd like to open us with prayer, and this is the collect for the stewardship of creation from the Book of Common Prayer. Let us pray. O merciful Creator, your hand is open wide to satisfy the needs of every living creature. Make us always thankful for your loving providence, and grant that we, remembering the account that we must one day give, may be faithful stewards of your good gifts. Through Jesus Christ our Lord, who lives with you and the Holy Spirit, one God, forever and ever. Amen. It's also my pleasure to introduce Mary Kate Wold, the CEO and president of the Church Pension Group. Mary Kate joined CPG in 2011, and in addition to serving as CEO and president, is a member of the board of trustees of the Church Pension Fund. Mary Kate's service prior to coming to CPG included executive roles at Wyeth in the pharmaceutical industry, as a partner at the law firm of Sherman & Sterling, as well as service within the Department of Treasury. While Mary Kate has served and continues to serve on both for-profit and not-for-profit boards, importantly, she is also a faithful Episcopalian who over the years has served on the vestries of 3 Episcopal churches of various sizes. Mary Kate uses all these skills to provide strong and clear leadership to CPG and its affiliate companies so that we might be successful in all that we do for the Episcopal Church. Mary Kate.
Thank you, Clayton. Well, welcome everybody. This is our first Insights and Ideas event for 2023. I think I'm still saying Happy New Year to people, and I realize now we're in mid-February, so time is flying. I was just asked as we were preparing for this a few minutes ago how many of these we've had, and actually we started over 5 years ago, and we've been hosting at least 4 of these quarterly every year. So this is one in a long succession of insights and ideas focused on the topic of socially responsible investing. Socially responsible investing is in the news a lot, controversial in some areas, and just definitely evolving. So we thought that it would be helpful today to define the landscape. We'll talk a little bit about definitions and opportunities to get involved in socially responsible investing, some of the issues that are arising. And we have today 2 of our panelists who help others invest in the socially responsible space, and then 2 of the panelists who actually do socially responsible investing directly, and that would be CPG and Trinity Church Wall Street. And I'm very excited to have these 4 experts with us today. So let me start by introducing the panelists. I'd like to first introduce Ally McDonald, and Ally is the CEO of Boston Common Asset Management, and that is a women-led, women-owned asset management firm focused on and let me quote, better portfolios for a better world. I think that's a great tagline. Ally's held numerous senior roles in the financial services industry over the past 20 years and has pursued significant professional endeavors that drive positive social impact. And let me say, she's not only bringing her intellectual and professional skills to bear, but her athletic skills as well, as I've seen that she's also a marathoner raising money for many good causes over the course of her many miles on the road. Our second panelist is Bhakti Mirchandani, who is the Managing Director for Responsible Investing at Trinity Church Wall Street, a thriving, and in all caps thriving, congregation in Lower Manhattan with a historic real estate and securities portfolio via gift from Queen Anne well over 300 years ago. In addition to her role at Trinity, Bhakti is a professor at Columbia University here in New York and a contributing author at the Milken Institute and Forbes. And then we have Anne Richardson, and Anne is the Senior Program Director for Investor Relations at the Episcopal Church Foundation. At ECF, she works with various Episcopal institutions, churches, dioceses, and schools to successfully manage their finances and investment portfolios. And she brings a lengthy career in consulting and asset management to this role. And also she has the unique kind of in the trenches parish experience, having served as Director of Development for Christ Church, the historic Christ Church in Virginia. And then lastly, we have Christopher Rowe, my colleague. Christopher is a managing director on our investment team. He has many roles, but importantly, he leads our efforts on socially responsible investing. And prior to coming to the Church Pension Fund, Christopher spent more than 25 years in the asset management industry, where he worked with clients on the intersection of their values and finance. And you can see more fulsome bios of all of these really incredible individuals in the chat. And as you'll see, we have quite a bent today, not so in a lot of these, but quite a bent towards the Episcopal Church today in terms of the expertise and roles of our panelists. So let's jump right in and I'll ask some questions. It's going to be very interactive. And as you know from Jermaine, you're welcome to insert your own questions. And we will be answering those as we go along, but also leave time for questions at the end. So Bhakti, you are a professor, so you're my go-to person for this question. I think your title is responsible investing. I've used socially responsible investing. We talk about ESG, we talk about sustainable investing. There's a plethora of terms out there for what seems to be maybe the same thing or kind of a Venn diagram of concepts. Can you help ground us and talk a little bit about how you think of defining these various terms that we're bombarded with in this space?
Sure, I'm happy to. And I think a lot of the challenges that ESG and sustainable investing are facing are definitional questions and the use of definitions. Sustainable investing is the broadest category. It includes ESG integration, screening, sustainability themed investing, impact investing. All of those are forms of sustainable investing. Responsible investing is sustainable investing plus advocacy for the field. And that's often best done by asset owners or by organizations that are, nonprofits. Within the main types of sustainable investing, impact investing are investments that aim to make a social or environmental impact and measure that impact. And there are 9 components to that we don't have to talk about now. Sustainability themed investing is investing in sustainable themes or assets explicitly, but not necessarily measuring them in as rigorous of a fashion as impact investing, but very similar. ESG integration is the systemic and explicit inclusion of ESG factors into financial analysis, and screens can be positive, negative, or just screening out the most abhorrent things that are at odds with norms. So there's a wide variety of types of screens. One thing that used to be considered sustainable investing, but has become so commonplace, it's become part of the mainstream, which is an amazing development, is investment stewardship, or the investor-investee dialogue focused on sustainability.
And so when you talk about sustainability, some may think that just refers to environmental issues, but it's gathering from you, it's a much broader concept.
It is a much broader concept.
These days.
Thanks for clarifying.
Great, thank you for that. Well, with these definitions as a foundation, I'd just like to ask each of you how you employ these concepts within your own organization. So, Allie, could we start with you?
Sure, happy to. And full and fair disclosure, I've not run a marathon for 5 years. I'm hoping to get up over 5 miles soon. But thank you, Mary Kate, for having me in that great introduction, and Christopher as well. So Boston Common Asset Management, we're celebrating our 20-year anniversary this year, and we were founded on the concept that responsible investing, you should invest responsibly, seeking financial return alongside the well-being of planet and people, and really just use a complete picture of value in companies. So our founder, Geeta Iyer, is a pioneer in this space, and we are a bit unique in that we are, as you said, Mary Kate, women-led and majority women-owned. We've remained independent, where many of our colleagues and pioneering colleagues in the space have not, and we've done so we can continue to invest in the way that we think is right and not conflicted with other forms of investing. When we think about these issues, we don't use sustainability a lot when we're talking about how we invest, because it's used so widely and broadly, and oftentimes it points to environmental issues. I really like the definition of sustainability that simply means meeting our own needs without compromising the ability of future generations to meet their needs. And if you just think about sustainability in that regard, everything that we should all be doing is focused on that. So I do like the way Bhakti uses that as kind of the all-encompassing umbrella, but we don't use it a lot. We think about socially responsible investing. We go back in time where socially responsible investing, as you all know, was started by faith-based organizations, right? It was the Methodists, I believe, back in the 18th century, decided that they didn't want to own certain things, and they didn't feel like investing in companies whose core products caused harm. And so that real concept of socially responsible investing was more about what you don't want to own, negative screens, thinking about that. And things have obviously evolved over time. The UNPRI, United Nations Principles for Responsible Investing, really popularized the concept of ESG, which is environmental, social, and governance factors in your investing, and thinking about how all three of those work together. And then the concept impact is another one where everyone talks about impact investing, right? And how I think about it is every dollar has an impact. It's whether it's a negative, a neutral, or a positive impact, and you can think about it along those ways. At Boston Common, we do a little bit of all of it in our process when we think about investing for our clients. We do have things we avoid investing in, but we do spend most of our time focusing on that ESG integration and how we think about those factors across our investment process. And then how we feel we have impact is through the engagement of companies, through really using our investor voice to engage companies and make them better along those lines.
Thank you. Anne, what about you and the Episcopal Church Foundation?
Thank you so much, Mary Kate. Delighted to be here with everyone today. So just a little background on Episcopal Church Foundation, recognizing that not everyone who's joined us today might be familiar with it. So Episcopal Church Foundation, or ECF, is an Episcopal nonprofit. Certainly we are affiliated with the Episcopal Church, but we are not the Episcopal Church with a capital T. We are our own separate nonprofit. And through one of our programs, we manage endowment and other long-term funds on behalf of over 325 churches, dioceses, schools, seminaries, and other Episcopal organizations. And so when a church or another potential client comes to us and asks us about SRI, socially responsible investing, or about ESG, environmental, social, and governance, we really use this as an opportunity to learn about what's motivating their interest and what their desired outcome is. And we see that these conversations are often an opportunity for education about the responsibility of investors in the public markets. And that responsibility is twofold. The first is transparency. So that's in the form of encouraging investor relevant disclosures from corporations. And then the second is what Ally was just talking about in terms of advocacy, or some people prefer the term voice, in the form of corporate engagement, and then of course for equities, proxy voting. So at ECF, we generally think of SRI as sort of an umbrella term that incorporates all of these important aspects of investing. And then ESG as referring to the wealth of data that has become available through investors' request for transparency, and also through investors' use of their voice to help us compare companies in similar industries. And we offer portfolios for each approach.
Well, I think we've now heard from three experts, and we're seeing that there isn't complete alignment in terms of how we're defining these terms. So to my original point. Great. Well, Bhakti, tell us a little bit about Trinity Church Wall Street and what your approach is on these issues.
Sure, would be delighted to. With respect to Trinity Church Wall Street, our strategy is three-pronged. We take a manager baseline and we screen for the future. So there are 21 factors that roll up into 9 indicators that roll up into 3 pillars, and we use that. And the pillars are portfolio sustainability, manager sustainability, and diversity, equity, and inclusion. So we underwrite all of our current and prospective managers with that framework. That sets the foundation for this next prong of our strategy, which is strengthening and supporting manager transitions towards sustainability and inclusion. The first part of our work, our screening, all happens via 1-hour phone call. It's not a survey. So we have discussions with portfolio managers or CIOs, kind of heads of firms, to just have to start to build that foundation of trust. with our managers, every year we pick a theme, a sustainability theme, and we ask managers detailed questions about those themes from across our portfolio, and we share best practices on a no names basis by asset class, so our managers can see what others are doing in that space and improve or try out new approaches if they approach. Our third prong is very specific, narrow set of issues with respect to racial justice that we strategically engage directly with clients on, or we exclude from our portfolio. So that's our general approach, and it remains stable. This year, our deep dive themes for manager capacity building focuses on governance.
Thank you. And Christopher, you want to talk a little bit about what we do here at the Church Pension Group?
Sure, I'd be very glad to. Thank you. So, and there is definitely some overlapping themes with my fellow panelists, but at CPG, we use the term socially responsible investing to reflect our collective efforts to support church values through our investment activities. And our socially responsible investing strategy is divided into 4 pillars. Pillar 1 is impact investments. And so these are finding investments that have a positive social impact, but a market rate of return. Our second pillar is ESG incorporation. And so, and others on the panel have talked about recognizing that environmental, social, and governance issues are drivers to investment return and risk. And these issues are not only important from a financial perspective, but they also align to many of the church values. So environmental issues align with care for creation, issues around worker health and safety and well-being relates to our call to support the voiceless, and working on issues of diversity focus on racial reconciliation and justice. Our third pillar, and many on the panel have talked about voice, is how do we use our voice as an owner of public companies on issues of corporate social responsibility. So as shareholders of public companies, we have a voice in how they approach key strategic issues and can engage with companies in dialogue. And our fourth pillar is actually, today's webinar is actually representative of our fourth pillar, which is how do we convene and connect investors and stakeholders and individuals interested in this work to enhance best practices and at the same time also catalyze growth in the space. So those are our 4 pillars under the umbrella of socially responsible investing.
Great, thank you, Christopher. Now, there's a lot about socially responsible investing in the news, and people have different focuses in terms of their work. So I'll just leave it a free-for-all. Can some of you jump in and talk about the issues that are the issues you're seeing kind of in the news in the world, but also the themes that you're really giving priority to in terms of your focus these days?
I'm happy to jump in. I thought it might make sense, though, too, to clarify for people watching that my firm, we create investments, right? We make investment strategies, and Bhakti's firm would be looking at us as a manager, right? So she would be assessing whether or not we are good at what we do and whether we fit into one of her investments. I just thought that might make sense to bring up. So as Mary Kate said in the beginning, there's so much discussion around sustainable investing, both good and bad, and we can get to some of the bad later. But when I think about all of the work there is to do for those of us that care about people and planet and trying to have our investments reflect that, we could sit here and list issue areas for hours. But when I think about the business and what is facing us as a small boutique asset manager trying to be great at what we do, regulation is a big thing on our minds. So there's been a lot of talk from the SEC about regulating various ESG firms and funds that are put out into the marketplace. And likewise in Europe and overseas, there are things that they have been thinking about for years that are now coming to play. And we manage money in both places. So if I think about a key issue for asset managers in this space is thinking about how to handle regulation. In the US here, we actually, Boston Common, we welcome the regulation, because what that will do is for an authentic manager like us who does this in everything we do, we don't worry about the regulators coming in and checking to see whether or not we're following proper ESG practices, or whether or not we're representing that we're doing something that we're not along those lines. So that's good. In Europe, where it is far more detailed and actually somewhat different on how they're thinking about sustainability and how they're thinking about measuring funds, it provides opportunity for us to have to spend more money, buy more data, and report differently. So regulation is a big thing on our minds here at Boston Common. And then the other really key issue, as we're all talking here and using these terms for different things, integration is really a key point. And this is something that we've been a leader in for years, thinking about how you think about the factors in your portfolios, how you scrutinize a company to make sure that you're understanding deeply their ESG priorities and components. The good news is there's more data available these days. There's more things to help with our independent research to be able to integrate. But we focus on continuing along the investment line, our fiduciary or our financial investment, fundamental investment team, our ESG research team, and our engagement team to make sure that we're really engaging so we can get the clients the best returns possible, as well as engage companies on their behalf. So I would say those are two kind of big issues for us this year.
And Ally, actually, that relates directly to one of the questions we just got in the Q&A, which maybe we can follow up on that, which is you sort of alluded to, there's a lot of data out there, there's a lot of information out there, and as you mentioned, you're making investment decisions for large investors and small investors like Trinity Church Wall Street and like the Church Pension Fund. Where do you get the data that you need to make investment decisions? And how do you evaluate the data that is presented to you in terms of deciding which companies to invest in?
That's a great question. And I should say that Boston Common, we're an active manager. We aren't a quantitative manager, which means we hand do our own diligence. So we're aware of, there's a lot of different data providers out there in the ESG space, like MSCI and ISS provides different types of data that we can then use to help us make decisions. But we make these decisions based on understanding the company. We, of course, are using various services to understand a company's fundamentals and their financials. And then on the ESG side of things, there are various sources that you can, Vigeo Eiris, LexisNexis, Sustainalytics, all these various sources that you can look at to make sure and check your research and say, okay, are we thinking the same thing along these lines? So it's very helpful. I mean, for a firm like Boston Common, where our head of ESG research has been doing this for 3 decades, and he understands patterns and he understands how companies act, we're really using the data and new information to make sure that we're staying ahead of the curve and we're seeing the issues that are coming down the line and how they've changed over time to make those ESG decisions in a better way. That's a good question. There are also, someone asked about an index fund I saw earlier. There are other firms that will just take data and run a set of stocks through that screen and then come up with a portfolio. So it's very simple and not customized, and you can do that with the amount of data that's out there today.
Thank you. Bhakti, I think you were about to jump in as well.
I think I wanted to kind of talk about 3 things. One is that there's much more consensus than you would think by listening to all the political theater, because a lot of it is just political theater. I wanted to share what's 2 main things that the critics were missing, and then a couple of things that the sustainable investing industry is missing and can work on. So first of all, there's consensus around the energy transition, around climate adaptation, and on focusing on financial materiality in investment decision making, and both parties aim to be the party of the working class. So in terms of consensus on the energy transition, even though Republicans didn't vote for the Inflation Reduction Act, a number of their states will benefit significantly from the jobs that are being created. In terms of climate adaptation, the Biden administration released a plan, and then House Republican Kevin McCarthy asked Republican colleagues to come up with climate change strategy themselves and building resilient communities. In terms of materiality, Ron DeSantis made the case that investment should be made on financially material factors. And if you look at ISSB, SASB, SEC, they're all looking for financial materiality as well. And then in terms of both parties wanting to be the parties of the working class, Republicans gained a significant number of blue collar workers. Biden administration made the statement that they wanted Biden to be the most pro-union president of a pro-union administration. So it looks like, although there's a lot of argument and there are relatively minor differences, there's a lot of consensus, and that gives us a good starting point. In terms of systemic risk, if we believe the climate models, and the climate models have seemed pretty accurate so far, there's been no snow in New York City for the first time. I've never known that this is the case. So if you look behind me, you can see that there are lots of pictures. By the time my 4-year-old is my mother's age, if we believe the climate models, only the mid-level latitudes of the world will be habitable. And the world will only be able to support 1 billion people. And if we believe those climate models, there's no investment portfolio that can do well in that scenario. So that makes climate risk a systemic risk. COVID also showed us that there are a number of social systemic risks. The 27 million uninsured Americans, the number of Americans without sick days, those types of issues can really cause issues in a society, social issues just spiral out of control. There was a number of racial justice issues, all these issues that seemed like they were company specific actually were systemic. So taking into account those systemic risks, not only particular investments in particular companies, but the whole investment ecosystem. So those are some of the points that would be made for the ESG critics to consider. In terms of the sustainable investing community, there are trade-offs between social and environmental. New research shows that firms pressured to improve environmental performance do so at the expense of social status, committing more compliance violations related to employment, healthcare, workplace safety, and consumer protection. This is important to us at Trinity Church Wall Street. We care deeply about climate. Stewardship is one of our values. If climate goes extremely poorly, in 100 years, our property will be beachfront property. So we care deeply about climate, but we also care a lot about racial and social justice. We have to be careful what we ask our managers and we ask their companies to commit to if we want to keep some of those issues paramount. So just being realistic about what companies can achieve with their limited resources is important. The last piece is that 2040, net zero by 2040 will not happen. So investing in a net zero by 2040 aligned portfolio means that you're over investing in companies that would benefit from a rapid transition and under investing in companies that would not make that would anticipate a slower transition. So it's really kind of investing across timeframes so that you invest in some companies that will help green the current use of internal combustion engines and make certain types of dirty industrial processes cleaner, so that even if there's a longer transition, you're being mindful of climate and you're also being realistic about the pace of change that's in society while hoping for a faster rate of change.
Thank you, Bhakti. And I think you're raising the point that none of these issues are simple and they're conflicting interests. I was just listening to a podcast yesterday about electric vehicles, and it's so exciting, but on the other hand, the kind of mining operations that will be necessary to produce the batteries can devastate some areas. So all of these have trade-offs, and it's really important to understand the facts and to be able to make fact-based decisions, I'm sure. And what about you? What are you focused on in terms of themes?
Yeah, thank you. I actually wanted to pick up on a couple of topics that came out in the comments. The first is just to underscore the issues that Bhakti was highlighting. At ECF, we work with and talk to churches and other Episcopal organizations across the country. And so the issues that we hear are pretty diverse, but there are a couple of themes that seem to emerge continually. And those are two of the ones that Bhakti mentioned, a focus on human capital, I think particularly in terms of how corporations treat their employees. And then also, of course, climate change. And I think the people that we are talking to are pretty cognizant of the fact that addressing the impacts of climate change is going to be a multifaceted approach. It's going to be about individual choices, organizational choices, government policies, and then also what you can express in an investment portfolio. But there's really only so much there, right? There's a lot of other things to be considered. And then to pick up just on what Ally had started talking about and one of the questions that we got in the Q&A, yes, there's a ton of data out there. And one of the things that investors focus on is what of that data is financially relevant to an analysis of a company. And then also there's actively managed strategies like Ally was talking about in terms of what Boston Common offers, but there are also passive strategies that can use this plethora of ESG data to construct a portfolio. And for our clients, ECF offers 2 portfolio strategies that explicitly incorporate ESG data into the investment product, and they seek to tilt toward companies that are doing better on financially relevant ESG metrics. And they also do screen out a few categories just based on simple business involvement. And for us, we think that for churches and for other faith organizations that want to be part of a movement of capital, showing that investors value disclosure and transparency, these portfolios are a good option. And one of the things that we try to do is help churches have a good understanding of their options and creating a diversified portfolio that's focused on public markets, and then to talk through with them some of the considerations related to responsible investing. And one of the things that we find in these conversations that, again, touches on things that Ally and Bhakti have also said, it can be easy to confuse value and values. So what I mean by that is that there are a lot of investment firms who are using ESG criteria to help them assess risk as part of evaluating a company's overall value. And then there are investors like churches who are looking at the list of things that go into a detailed ESG analysis and saying, yeah, a lot of those things do match our values. There's nothing wrong with this disconnect, but I think it's important to understand that ESG is not synonymous with values.
Thank you for that. When Christopher mentioned our 4-pronged strategy at CPG, one of the things he mentioned was shareholder engagement. And by that, we mean engaging with the management of public companies in our portfolios, where we have an equity interest, and increasingly, I think, where we might have fixed income owned bonds in a company. But there's an opportunity for investors, by virtue of their ownership interest, to actually engage with companies on various topics. So I'd like to ask all of you how you employ shareholder engagement with respect to your portfolios.
Well, I can jump in on our strategy, which is, and I mean, the values that we've talked about and our issue priorities for 2023 are fairly narrow on the impact investing side, where we're looking at clean energy and solutions to climate change. We're looking at investments that can address issues of economic disparity. But then if we move over to the shareholder engagement side, we can be a bit broader on the issues that we try to tackle. So certainly we're trying to address issues around climate reporting, climate transparency. We're trying to address issues of human rights and issues of worker health and safety and supply chains and human rights issues in conflict zones. There was an issue pointed out in the chat around LGBTQ issues and how do we deal with those kinds of issues where perhaps a company's policy could be hostile toward those individuals. And so the process of shareholder engagement, shareholder dialogue allows us to raise these questions directly with companies, recognizing not only is there a moral value issue with those, but there's an economic value in terms of how are you attracting employees? How are you attracting customers if you're not treating that community well? And so
for that's a good job of kind of talking about some of the substance of these engagements. But could you say a little bit about how this actually works? How do you do this?
Sure. Taking a step back. So that's the substance of the issue. But at the forefront, really all it is, it starts with dialogue. So as investors in public companies, you have a right to reach out to company management and raise issues that are of importance or concern. And so that dialogue may or may not be well received. You can send an email, you can place a phone call, and generally companies may or may not respond. For the cases where they don't respond, there is an additional lever that you can pull, which is a shareholder proposal. That is, you can put an issue on the ballot for consideration by the company. Generally, companies don't like issues being put on the ballot. And so if you use that as more of a stick than a carrot in terms of incenting companies to come to the table, and that is the opportunity to really raise issues of importance and bring them to the table. There are times that even when you file a shareholder resolution, they don't come to the table, in which case it goes to a vote, and shareholders can decide on the issue.
Thank you. Others, Ally and
Yeah, Mary Kate, I was going to cover a little bit of how it works and maybe give an example how we implement our engagement strategies. And I do want to mention, though, that there are great organizations like ICCR, the Interfaith Center on Corporate Responsibility, and other consortiums where we as an asset manager partner together along those issues, those systemic issues that Bhakti raises, and some of those other issues that Christopher was just talking about, because together, Boston Common is a $5 billion asset manager. How much can we have if BlackRock's voting in the opposite direction? How much pull do we have? But because we've been doing this so long and we've been doing it with other interested investors, people listen to us and will usually take our call. But at Boston Common, I think for us, just to cover a few issues, we have to get to the point on value that Ann mentioned, we have a comprehensive set of ESG guidelines that frame everything we do. So that's the framework with which, when we look at a company like a company that is potentially going to have green hydrogen in the future, and we say that's a great solutions company, let's look deeper. And then we look at that company and say that they operate in Saudi Arabia, and we say, well, we can't operate there. So we're constantly making trade-offs based on these frameworks. And we manage a lot of money for faith-based institutions. And over time, its ESG framework has evolved, what we've learned from our clients, what we've learned from the marketplace, to the point where once we have our comprehensive guidelines done, and then an organization comes to us and says, here's our list of things we don't invest in because it's bad for people and planet, usually the stocks that we invest in are included, right? So there's oftentimes with certain faiths, there's like 2 stocks that we have to take out of a portfolio to do that. So there is the value. We're always looking at what is the material value in that company and how are these ESG factors contributing to it positively or negatively, risk and opportunity. But then it's expressing the values of our clients and making sure we don't own anything that they don't want. When we get to the point of we're going to actually purchase a security, so we find a company, we say we like this company, passes our guidelines. The ESG team has done a deep dive on the company, and they write a report that says, here are the material issues of that company. Here's where they're really strong on ESG, give them a thumbs up. And here are a couple places that we see where we could have a benefit if we engage them. And that's what Christopher said. You send them a letter. We do an initial purchase outreach and say, hey, we're a new shareholder. So happy to own you. Here are 3 areas that we think you could get really better on. And we have experience helping companies. Now, we are doing this because we want to see impact and change, but we're also doing this because we're investors. We want to see alpha or better return. We want to see the company get better. And we truly believe if they get better along these lines, they're going to be someone that be better to own. So you start those dialogues, you have those conversations, and then you engage them over time, and hopefully, they will become a better company. Our head of stewardship just got back from Japan, where she met with 8 of our portfolio companies, and not only did she meet and talk about the key issues affecting that company. There's a water company, there's a financial services company, and you talk about different issues that affect those companies, but we do that on behalf of our clients. So some of our faith-based clients that are interested in the same issues, we're engaging on their behalf while we're there overseas as well. So that's kind of how the whole thing works. And we all talk to each other about how's the company doing along these lines. And Christopher, as an investor for us, if they don't call you back and they don't want to engage, there's a little bit of a mark there to say, why are they not interested in hearing from an investor on how they can get better?
I think one of the important issues you're raising is the significance of joining together with like-minded groups, which ICCR is a great partner. And we also work with the Committee on Corporate Social Responsibility of the Episcopal Church. So I think we always see that these efforts are much more successful when you get a band of like-minded organizations together. Bhakti,
Absolutely.
I know that Trinity Church has been very active over the years in shareholder engagement. Do you have any examples you could share?
I'm happy to. I'm so glad that you're raising this issue because strategic engagement is the most effective form of sustainable investing in terms of making an impact, and that it's most strongly empirically proven. So it's something that we should all think much more about. With respect to recent engagements, we've engaged on ghost guns with card issuers through our managers. We've engaged on ensuring bail bonds through our managers as well. Both engagements were effective. And then we've engaged directly with big tech on algorithmic discrimination and eliminating other forms of racial bias and also facilities surveillance. So very narrow set of issues focused on racial justice. Our strategic engagement is primarily with our managers. So we see that asset owner, asset manager dialogue is the most as a fulcrum of the investment value chain. So we see that together we can do a great deal with our managers. And in 2020, we engaged a great deal on diversity, equity, and inclusion. Last year, we engaged in detail on climate, both at a manager level, at an underlying position level. We look in terms of opportunities and risks. And this year we're deep diving into governance, including geopolitical risk, human rights, and some of the more standard corporate governance issues. So stay tuned.
Terrific, thank you. And Anne, what about you all on behalf of your clients?
Yeah, so at ACF, we have an investment partner, similar to what Bhakti was saying, you sort of engage through your manager. So our investment partner has a really robust asset stewardship program. It includes both corporate engagement and use of proxy voting. And some of the issues that we've been focused on recently through our investment partner are actually looking at the risks of plastics in the company's business and opportunities that might arise as the result of everyone, I think, is hoping to move toward a more circular economy. We've also talked a lot, as I said earlier, how companies treat employees as something that's really of interest to a lot of the clients that we have. And some of the engagements that we've done have been about corporates' disclosure of their human capital management. And then we've also had engagements on governance. I think as investors, one of the biggest areas where we make a difference in terms of our public company investments is through our ability to vote for some of the board members. And we should really be focused on governance because as investors, we're not telling the company how it should be run, right? That is the job of management. But part of what we're doing in engagements is telling the company to tell us as investors how it is being run. And then also taking a really strong look at governance. As Bhakti mentioned, I think that's one of their priorities at Trinity Wall Street this year. And so seeing, what are board member time commitments, for example, or how long do board members serve? How many boards do they serve on? These are important things for us to understand as investors and thinking about how a company is governed.
Thank you. And before we go on to other issues, I know someone raised in the Q&A a question of shareholder engagement in the area of human trafficking. And Christopher, I know we for one have had some success in that regard. So maybe you can give an example and others, if you have examples on gun violence or human trafficking issues, feel free to jump in as well.
Yeah. So our focus on human trafficking has largely been directed at airlines and transportation companies. So it's not as if airlines are actively engaged in trafficking, but they are in a position to stop trafficking, and in particular, stop cases of sex trafficking. And so in one particular engagement we've had with one of the major airlines, they've had stories of success that were deeply moving, where they've largely publicized the fact that they are aware that trafficking occurs on their airline. They provided a mechanism by which individuals can actually communicate that they're being trafficked, and the employees themselves are well educated. And so the advocacy work that we have been doing has been around making sure that employees are well educated on the issues and where to spot cases of trafficking and how to appropriately respond.
Thank you.
While
I just-
I'm talking, I'd also like to follow up on another question there where somebody asked, where can we find information related to the engagement work that CPG has done and others have done? And so one document that I would point you to is the Blue Book. So at General Convention, we work closely with, as Mary Kate mentioned, the Committee on Corporate Social Responsibility, CCSR. And that is the committee of executive council that does the shareholder engagement work on behalf of the trust funds of the Episcopal Church that's overseen by Kirk Barnes, the treasurer of the Episcopal Church. And so we work with CCSR on a number of different issues, and then we report on the success of those engagements in the Blue Book. So I would encourage you to both look at the CCSR submission in the Blue Book, and then also the CPG's submission to the Blue Book as well.
Thank you, Christopher. And Ellie, you were going to jump in.
Yeah, I did, because it is a very pertinent issue for us. This engagement work that we do as an asset manager, oftentimes we get questioned, how do you really track it? How can you really see if you're having success? What are, can you tell me how your engagement with the company has increased their stock? And so some of that stuff is really hard to put your fingers on it. But in human trafficking, and sex slavery, we actually engaged Marriott International. Now we engage a lot of companies internationally and on behalf of our faith-based clients. And we engaged them in, I think it was 2008, 2009 with a Swedish organization. And over time, we got them to change the way that they train their employees. So now anyone that goes through Marriott International is trained on how to look out for something that may be human trafficking or something, sexual violence and those types of things. So it's something, a small company like ours was able to partner with a bigger organization and convince Marriott to take real action over time on that. So to the question of human trafficking and those other issues, we're all thinking about these issues, and we're thinking about how we use investor voice and capital to make sure that we aren't encouraging, these bad behaviors.
Thank you. And we're going to be running out of time, and I want to make sure that I touch on at least one other important issue, and that's the issue of diversity, equity, and inclusion in the asset management space. Finding managers who, Ellie is an example, but finding managers who are owned by diverse owners, and finding asset managers who have leadership and investors from a variety of different demographics. And can you each talk a little bit about how you advance the issue of DEI in the amongst managers and in the asset management industry?
I'm happy to jump in. Diversity, equity, and inclusion is one of the three prongs of Trinity's investment approach. Whenever we diligence a manager, we look at team diversity, both the team stats and also recruiting, retention, promotion. So that's the team aspect. We look at the investment portfolio. There are 21 ways in which our managers either select for or promote diversity in their investment portfolio. And there's kind of both the status of that and the momentum. And then we look at service provider diversity. Are their service providers diverse? And are they purposefully selecting for it? So that's what we do within our own portfolio. Market wide, Sophia Tsai and I from the Trinity investment team, and then two members of the University of Rochester investment team, put together an organization called Institutional Allocators for Diversity, Equity, and Inclusion. We started working on this in October of 2020. We focus on both widening the funnel and changing the shape of the funnel. Right now, we have 610 institutional allocator members, primarily endowments and foundations. In terms of widening the shape of the funnel, we have the largest open source list of asset managers, diverse owned and diverse led asset managers. So no endowment and foundation will ever be able to say now that they can't find a diverse manager. Mm-hmm. We also, in terms of changing the widening the funnel, what we do is we have every other month, we have manager pitch sessions, which are 1 hour, and our membership votes on which manager they want to hear from. This is kind of by asset class. We have different sessions, and an hour session, you'll hear from 6 managers. And then we track the AUM that's been raised as a result of these sessions. It's in the 9 figures, but we don't always hear back. We hope that, we do all this volunteer work that we just want to hear back and track, but at least 9 figures is a good place to start. And it's like mid 9 figures, but hopefully it'll be much larger than that. In terms of changing the shape of the funnel, we've convened a number of sessions with what we call our cousins, which are other organizations that focus on investing in diversity and inclusion. There are a lot of nonprofits that have been doing that for years, and some, for-profit stakeholders that care deeply about these issues. We've written 13 articles based on this. We've come up with a couple different toolkits, one in partnership with Millikan Institute, and we're hoping that the insights that we're sharing from those discussions will help change the way that that processes work.
That's outstanding work, Bhakti. Thank you. And I'm glad to hear that the questions are also nuanced. It's not just a question of how many women and how many people of color do you have in your organization, but you're looking at their positions within the organization and their seniority and influence, which is really important. Others?
Well, one of the areas that we're focused on is, in addition to diverse ownership, which is critically important, we're also looking at diverse leadership. And so in addition to partnering with Bhakti on her initiative, we are active in another organization associated with an organization called ILPA, which is a group of investors just like the Church Pension Fund, where we will engage with all of our asset managers every time we make a new investment, asking them questions around where do they have individuals in different roles, and what are their functions? Do they have at senior leadership, at investment decision making, and more? And we believe that this is really a collective effort by a lot of asset owners, that if enough of us really start pressing and asking the questions, there will be movement.
Thank you. There was one question in the chat that I want to make sure that we get to, and that's going back to the beginning, Christopher, when you mentioned looking for returns as well as impact. And the question was, well, why can't we sacrifice returns for impact? And I think the answer is it depends. It depends on what kind of organization you are and what rules and regulations and laws apply. So I think Trinity Church Wall Street is a different animal than the Church Pension Fund, and parishes that Anne works with are different than the Church Pension Fund. And I'm sure, Ally, you have a variety of different types of investors, some of whom have a lot of latitude to do what's called concessionary investing and therefore leave some return on the table to do good. And other organizations don't have that same flexibility. So Christopher, do you want to remark on that, please?
Yeah, for the Church Pension Fund, and this touches on a point that was made earlier, that when we think about collective values, it's highly nuanced. In some cases, one value may rub up against another, and you have to work through it. And so one of those elements, which the question touched on, is, well, if we're making an investment with positive social impact, why can't we just sacrifice returns? Well, that goes straight up against a value that we hold dear, which is the value of keeping a promise. We have made promises to beneficiaries that we will make the pension payments that they were promised. And so that requires earning a market rate of return. And so that is, you can look reasonably at a given set of investments, and some are paying you appropriately for the risk you're taking, and some may not be. And we can't do the concessionary investment for positive social impact, because our primary purpose is paying pension benefits. Now, in other cases, your primary purpose may be environmental considerations or racial equity considerations, in which case, yes, you probably can make those concessions, but our primary purpose is to make sure that we keep our promises to beneficiaries.
And Bhakti, your Trinity Church is in a somewhat different situation. Incidentally, what Christopher is talking about in these fiduciary responsibilities are legally defined as well. So it's not just kind of our preference. But Bhakti, Trinity Church Wall Street has, I think, a much wider berth in terms of possible investments and the need to look for kind of competitive returns. Do you want to talk about the options that are available to you?
Sure. Well, what we do at Trinity, the primary objective of our investment portfolio is to continue to generate the resources to continue the mission activities of the organization in perpetuity. We already have 300 years behind us. We're kind of looking to 300 years ahead at least. So that's the goal of our investment portfolio. So we're investors first. We have a carve out of our investment portfolio for mission aligned investing, but that's a carve out in which, you know, mission is the priority, returns are important, but clearly mission is the priority. In terms of sustainability and inclusion, we find that we've been able to increase the diversity of our portfolio without compromising our commercial standards, because we've just widened the funnel, and widening the funnel without changing our standards or our thresholds has led to a more diverse portfolio. The managers within our portfolio, rather than, we definitely have some sustainability first managers, but we haven't compromised on returns to put them in the portfolio. And we found that even our standard commercial investors are very attuned to sustainability, and we have pushed them further. So one way to have a sustainable and inclusive portfolio is to seek out sustainable and inclusive managers. We've done some of that, but another way is to push your existing managers to be more sustainable and inclusive. So we've been able to have some success with that as well.
Thank you. And, you know, I've seen in the chat a number of questions from individual investors asking how they get involved. And we've been talking about from smaller institutional investors, like some parishes and that, all the way up to Trinity Church Wall Street and the Church Pension Fund with very, very large portfolios. But what about the individual? I know that most of you aren't working with individual investors, but do you have any suggestions?
So we do work with individuals about.
Great, thank you.
Yeah,
you're an expert. Thank you, Ellie.
We do, and it's a growing part of our business, in that there's just a lot of demand for people to have an asset manager that cared across the asset classes about integrating ESG and thinking about what it is that I own and what I don't want to own. So we do work with a lot of individuals who end up investing in portfolios that are similar to that of the institutions that we work with. But we've really been having deeper conversations with people about, where do I set up my bank account? Because that bank is not treating, that bank is not an inclusive bank. And what are the neighborhood organizations that, neighborhood banks that might be better for my cash? So you think about it all along that conscious consumerism, if you will, with the individuals. So we get down to talking about, where you can put your retirement money. If you don't have a pension, do you need, in your 401k, are there opportunities there? So there are other managers out there like Boston Common who work with individuals to find the right investments that meet their values. And I did see also in the chat, there's a lot of questions about fossil fuels in there and pipelines. And that's something I know that all of us have worked on. We are a fossil fuel free company. We no longer invest in that, but I know that a lot of us over time have also engaged and been active against the pipelines and in support of Indigenous people. I just want to.
And we've now run out of time, but I would say on the fossil fuels point of that, we have had prior I&I events that have addressed some of those issues. So if you go back on the CPG website, you can find some other panel discussions that address some of those issues. I want to thank all of our panelists. You were all superb. And I want to thank our interpreters and our CPG people who helped make this possible today. And I really want to thank our audience. Wonderful that you took a big chunk of time out of the middle of your day to join us, and it was gratifying to get all the questions. And as a moderator, very frustrating to me that we couldn't get to all of them. So I thank you for your very active engagement and wish everybody a great rest of the day. Thank you for joining us. And again, thank you to our panelists.
Thank you, Mary Kate. Thanks all.
Thank you so much.